Hello and welcome to this new video presentation. My name is John Paul Ngolo, and this video presentation will be based on intangible assets, more specifically research and development expenditure. These are the sub-accounts under account 2.1 intangible assets, and our video presentation will be on development expenses or development expenditure. So let us look at the table of contents of this video presentation. This is the table of contents of our current video presentation, and as you can see from the table of contents, our video presentation will stress on development expenditure, research and development expenditure, and looking as a whole as when we should capitalize development or research and development expenditure and when it should be expensed in the income statement, and how does the capitalization, the double entry of the capitalization of development expenditure. This falls within account 2.1 of the SYSCOHADA Accounting Framework. So if you are set, let us begin with our subject matter, starting by defining intangible assets. So to start with, we have to define intangible assets, and as you see, these are separately identifiable non-monetary assets without physical substance and are controlled by the entity. We cannot see or touch intangible assets, but as they generate future economic benefits and they are separately identifiable, it means they can be separated from the entity and maybe sold, used, or exchanged, or even rented, and that is why we record them as intangible assets. The intangible asset we are going to stress on this video presentation is research and development expenditure. This is an internally generated intangible because usually intangibles, for them to be recorded, should be externally generated. It means they should be purchased intangibles. But research and development expenditure, if they satisfy some criteria, as we are going to see, can be recorded even though they are internally generated and not purchased intangibles. But for us to look at the recognition criteria and the accounting of research and development expenditure, we have to start first from defining what research and development expenditure is. Research is original and planned investigation undertaken with the prospect of gaining new scientific or technical knowledge and understanding. So we see from the definition that the idea about research is to gain new scientific or technical knowledge. It's not to use the scientific or technical knowledge to do something, but just to get that scientific or technical knowledge. Examples of research activities are activities aimed at obtaining new knowledge, maybe the search for evaluation or application of research finding or other knowledge, the search for alternative for materials devices. So in a nutshell, you see that with the different examples of research activities, the idea is just to get some new knowledge. Not to use the new knowledge to do something, but just to get that new knowledge, just to get that new understanding. Let us look at the definition of development expenditure so that you can see the difference between the two. Development is the application of research findings or other knowledge to a plan or design for the production of new or substantially improved materials, devices, products, processes before the start of commercial production or use. So you see that in the development expenditure, and is underlined, we are applying our research findings to plan or design the production of a new or substantially improved. So for development expenditure is the expenditure incurred after research has been carried out. So with the research findings, with the outcome of the research, we use it to plan or design the production of new or better materials, devices, products, and the rest. And hence you can see some examples of development expenditure which you may encounter. So after having seen the definition of research expenditure and development expenditure, we will look at the initial recognition criteria for development expenditure. In other words, when should we capitalize development expenditure and maybe research expenditure? So, development expenditure will be capitalized if and only if the entity can demonstrate the following. First, the technical feasibility of completing the intangible asset so that it will be available for use or sale. It means that the entity must demonstrate that it will be technically feasible of completing the intangible asset. Then the entity must have the intention to complete the intangible asset. It must be able to use or sell the intangible asset, and it must demonstrate how the intangible asset will generate probable future economic benefits. It means that there should be a market or an existing market for the output of intangible assets, or if it has to be used internally, how useful the intangible asset is. The entity must have the adequate resources available to complete the development project. And then for the entity to be able to place a value on that development expenditure, it should be able to measure reliably the expenditure attributable to the intangible asset. So these are the 6 initial recognition criteria, and if an entity for a particular development expenditure satisfies, or a particular development expenditure in an entity satisfies this initial recognition criteria, then that development expenditure can be capitalized from the date it starts to fulfill all of these criteria. But if the development expenditure does not satisfy this criteria, then it will be expensed in the income statement. Let us then look at how research expenditure will be recognized in the financial statements. Research expenditure is expensed in the income statement. It is not capitalized in the income statement. For that, the standard is clear. Research expenditure is capitalized. The idea is with research expenditure, we are just gaining new knowledge. We are not yet using that knowledge to come up with a marketable product. However, if an entity cannot distinguish between the research and development phase of a project, all the expenditure should be treated as research expenditure, following the prudence concept of accounting. This is in line with IAS 38 Intangible Assets, paragraph 53. So after having looked at what is the recognition criteria for development expenditure, we then have to look at what constitutes development cost. Which type of costs are considered to be development expenditure? And the first thing to note that development costs are the expenses incurred from the date the asset satisfies for the first time all of the recognition criteria. I think we should stress on this word, all of the recognition criteria, because if only 2 or 3 out of the 6 elements of the recognition criteria are met and the others are not met, then the asset does not satisfy all of the criteria, and hence the asset cannot be qualified as a development expenditure and hence capitalized. And we only capitalize development costs from the date the asset satisfies the recognition criteria. From the date the asset satisfies all of the recognition criteria. It means expenses incurred before the date are not capitalized and will remain as expenses. They are not capitalized in the future. They will remain as expenses and expensed in the profit and loss statement. So, development costs include all directly attributable costs necessary to create, produce, and prepare the asset. So, these costs may include things like cost of material and services used or consumed, cost of employee benefits arising from the generation of the intangible asset, fees to register a legal right, borrowing costs when they satisfy the recognition criteria, amortization of patents and licenses that are used to generate the intangible asset. So these are some of the examples of directly attributable costs. In the next slide, you're going to look at costs which are not part of the development expenditure, costs which we should not include as being part of the development expenditure. So, as we said, these are the costs which are not considered to be part of an internally generated intangible asset or part of development expenditure. We saw how to recognize development expenditure, and we saw that we start to capitalize development expenditure when the criteria for recognition has been satisfied. In this slide, you're going to look at the double entry to recognize development expenditure. And in this case, we are assuming that the criteria are from the date when the criteria has been met, because before the criteria has been met, all development expenditure is recognized as an expense and will remain as an expense. But from the date the criteria has been satisfied, development expenditure will be recorded in the relevant expense account. Then they will be capitalized as assets by debiting account 211 development expenditure and crediting account 721 capitalized production intangible assets. Remember that development expenditure is an internally generated intangible, so it's just like a self-constructed asset. So once again, we are going to recognize development expenditure from the date all of the recognition criteria rules are satisfied, and from that date we initially recognize the expense in the relevant account 6, and then we credit account 721 and debit account 211 for the development expenditure. After initially recognizing the intangible asset in our financial statements, we need to know how to subsequently recognize the intangible asset, in this case the development expenditure, in our financial statements. And this will be the amortization of the development expenditure, which is spread out based on the useful life of the intangible assets. This asset begins to be amortized when the economic benefits are consumed. It means when the asset begins to be used or sold. So the double entry is with debit account 612 amortization expense of intangible assets, and with credit account 2811 accumulated amortization of development expense. Remember that account 2811 is the accumulated amortization or depreciation account, and it will be used to reduce the value of the cost account 211, in the financial statements. In other words, the difference between the account 211 development expenditure and account 2811 accumulated amortization will give the net book value of the development expenditure in the balance sheet. Having studied the initial recognition criteria of development expenditure and the subsequent expenditure or subsequent measurement of development expenditure, the amortization and the rest, it is only fair for us to look at the recognition criteria. How do we derecognize development expenditure from the financial statements? And the intangible asset will be derecognized when it leaves the entity, maybe the time has expired, or the entity does not expect future economic benefits from using the asset. The development or the intangible asset could be sold, it could have expired, or it's not useful again and it won't generate any future economic benefits for the entity. However, for development expenditure, it may occur that the project has failed, or the conditions for capitalizing development expenditure don't apply again for the entity. Therefore, the development expenditure which was previously capitalized should be immediately derecognized. If the conditions don't apply again for recognizing development expenditure, the next development expenditure should be expense in the income statement, and what was capitalized previously should be derecognized. In the next slide, we are going to look at the double entry to derecognize development expenditure, but the double entry is similar to a disposal of a fixed asset, which we saw in a previous video presentation. One last thing to note is research and development expenditure, which relates to the creation of a tangible good like a prototype, will instead be recorded using maybe the appropriate tangible fixed asset account or stock account, but not development expenditure account. So development expenditure relating to the creation of a tangible good like a prototype should not be included in account 211 development expenditure because it is not an intangible asset. We have a tangible good that has been created, and hence that tangible good should either be recorded as a fixed asset or should fall within the stock account. So let us look at the double entry then for the recognition of development expenditure. So when recording the disposal of the development expenditure, or the fact that the development expenditure project has failed, or the criteria is not satisfied again, this is the double entry that we are going to apply. The idea about the double entry is to close all relevant accounts which prove that the asset is still existing. It means first we are going to close the account of accumulated amortization of the development expenditure by debiting the account by the balance required to close the account. Remember that account is a debit account, it's a credit account, I beg your pardon, usually. And so by debiting it, we are closing the account. We will also debit account 811, book value of intangible assets disposed of, by the amount of development expenditure not yet amortized. In other words, the book value of that intangible asset at the date of disposal. Normally, the addition of this account 811 and account 2811 will give the credit in account 2811. It means that these two, account 811 and account 2811, their sum will be the balance in account 211, development expenditure. Hence, by crediting account 211, development expenditure, we close that account as well. So this is the double entry, and it respects the double entry for the disposal of fixed assets. So this is it. This is the end. Hope you enjoyed the presentation and that it has helped you to learn some facts about development expenditure in the SYSCOHADA Accounting Framework. Do check out the page for more video presentations on the SYSCOHADA Accounting Framework. We are looking forward to be your host on other future video presentations. Bye bye for now.